Right. I think we put ourselves in the camp that believes that the Chinese policymakers have been misunderstood. I think that the August 11th announcement on the renminbi, which allowed the currency to float downwards after many, many years of being pegged to the dollar at a fixed rate, that was handled quite badly, and we believe caused unnecessary panic sell-off in Chinese equity assets in Hong Kong, indeed Asian equity assets. We think the Chinese policymakers are really trying to rebalance the economy towards a much more stable, diversified structure whereby domestic demand, consumer demand, picks up the slack from a decline, an inevitable decline in net exports. Economies mature, you need the development of service industries. That's happened from the beginning of time, and we don't think the Chinese are doing anything to stop that happening. In fact, they're trying to accelerate that process. There will be hiccups along the way. But as we look at the Chinese strength in terms of its budget position, in terms of the level of indebtedness in the economy, there will be no banking crisis in China. Loan deposit ratios are quite low. They're only at about 70%, meaning that the banks haven't overlent relative to the deposit base. We don't believe that the level of indebtedness is that high. The Chinese debt levels have gone up, of course, because they've looked to spend money to soften the downturn in the West. But those are very, very manageable levels of indebtedness. And Chinese companies are actually being cleaned up. Certainly the purge, the anti-corruption purge is going on and probably quite unpopular. But they're looking to move the economy to a position whereby they can be accepted within the IMF as a reserve currency. So the renminbi has to move to become fully convertible, which is very attractive because it means that they're going to have to issue all sorts of pieces of fixed income paper that we as foreigners can invest into where the creditworthiness is very high. So we put ourselves firmly in the camp of this is a hiccup and a buying opportunity on the pathway towards full global economic citizenship. Yeah, there will be some losers. We look at the amount of money China is spending on boosting alternative energy sources, clean energy sources such as solar and nuclear power. And where there is a demand for coal, they'll be favouring the domestic coal mining companies. So Australian coal does look to be under something of a bit of a squeeze at the moment. Australian banks aren't particularly popular when they head offshore, and that's another issue for Australia. Banks dominate the equity market here. There might be an opportunity for Australian retailers. We have a company here, I think, called Premier Investments, which is a retailer looking to do its thing in Asian markets, and that strikes us as being a particularly fertile area. Consumers in China don't always want what the consumer in Australia wants, but there has to be skills that can be brought to bear, and Premier Investments appears to be doing quite a nice job up in Asia. And service companies too, financial services companies, what we do, I'd have thought would go down quite well in China. Capital will leave China as much as capital is attracted into China, and they don't have the skills to invest in private equity and real estate and distressed debt. And in fact, we've actually just signed up a deal with Ping An of Hong Kong, a subsidiary of Ping An Insurance Company, which is China's second biggest company by assets under management, $260 billion, and we're looking to find ways to bring what Ping An do, but also looking for things to bring to Ping An that they can use with their client base.